morning, traders. Welcome to the Traders Lab. I'm your host, Tom B. Can I please get a stream and audio check in YouTube and the Discord Trader Lab? Good morning, Marty. How we doing in YouTube this morning? And again, welcome to the Trader Lab. I'm your host, Tom B. The stream's about integrating Bookmap order flow tools with auction market theory using the volume profile as a chassis in the intraday developing time frame. This is about structured trades that are available to everyone at no cost in the Bookmap Discord Trader Lab community. Today is special in the sense that we are in a trend day configuration. For traders who don't understand trading, the market is unique, and at different times, even during the day, it can change, but a trend day configuration is not another walk in the park. The idea of the Trader Lab is to help traders develop trade plans that adjust with the current or developing condition of the market, because what works in one condition can be problematic and not have an edge in a different one. You know how to differentiate that? Well, that's the purpose of Trader Lab, to help you understand the business of trading, how the market works, why it does what it does, and how at times you can get in alignment with it, with structured trades that you could vet so you know the condition where they're qualified and other conditions where they're not, and also derive potentially a statistical edge, which puts the odds on your favor over a large distribution of random interactions with the other participants. That gives you an edge. And if you operate with an edge and have the discipline to actually execute the edge, the same as the casinos do over time, if you actually have an edge, the dollars will potentially flow over to your side of the table. I hope that makes sense. That's what the Trader Lab's about. It is about the business of trading. General disclosure, all Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this is not a trade calling room. If we get into real time, we'll talk. Also, if you have questions, please post them, and if I can't get to them, use the link in the bottom of YouTube. There's no cost to become part of the Trader Lab community. You won't be solicited or otherwise harassed. But if I can't get to your questions, come to Trader Lab, post them there. It is a community of like-minded traders who have come together to leverage their collective experience. This is about the business of trading. And if you want to create sustainability, you might want to be in an environment that's serious. This is business. It's not romper room. Anyway, you're all welcome, and thanks again for visiting the Trader Lab. Now, we got a lot to talk about, and again, this is about a trend day configuration. I'm going to move as quickly as I can, and if it's a little too fast, it's because I have limited time, and also I recommend you review these streams. They build one on top of the other, and also pass a link on to your trading friends who might benefit from a business approach to trading with the objective of creating sustainability. So let's get started. Take notes, review the stream. I'll do my best. Now, one thing I need to discuss with you briefly, and that is there's currently a contest going on. You can win 3 months of Global Plus with stocks and futures data. It's about a $600 value. It started October 1st, goes through the end of the month. And how do you participate? Well, screenshots of Bookmap with your trades, your setups, annotations, circles, arrows, and the rest of it. Post hashtag free blue jacket on X, Instagram, or LinkedIn. And here's the blue jacket that you can win. Very cool. And here's some examples. If you're in Trader Lab, you're already doing this. So take those screenshots and annotations and drop them in there with some explanation. Okay, guys, there's some examples. And you can also download my 60 PDFs that are available to you of structured trades. Remember, you have to reverse engineer them. And there are also examples that you can use. Don't miss out. Get those submissions in today. Pretty cool. $600 worth of subscriptions. Let's not sleep on this one. Hey, guys, now let's get started with the trend day configuration. We'll talk. First of all, and I was reminded about this over the weekend about when I started doing these streams. This is the basis of how the market works, at least as far as how I've shared a process, because we have to learn how to think in a hierarchy or process. And the thing is, it isn't the wiggle of the market, it is the alignment of the market. So, how do you build this? Well, first of all, how does the market work? It is auction. And what's an auction? Auction market theory is shopping. What's too high, what's too low, and what is fair? And since we're in a real time process of developing value, so when you go to supermarket, if a price is too high, you don't pay it. Very few do. If the price is on sale, forego in the cart, and then you have a retail price. Now, the time frame in the supermarket doesn't move quickly. You know, it's like, we're out here. But in our business, in our quote time frames, we are trading rotations. So each of those rotations is an auction of valuation. So we take the idea of the shopping experience and we bring it down to multiple time frames. They're inside a vertical integration of time. And if that confuses you, don't worry about it. This is not a snapshot and then off you go. This takes an understanding at a level, and this is not indicator oriented. This is actually behavioral. You understand how markets work? It will give you potentially an edge over those who are just plug and play, playing a video game, the gamblers. Now, again, you have to extract an edge. The tool to use that is called the volume profile. It's a representation of this auction process. Now, what time frame are you trading? Now, time frame, we use the term a little loosely because time is relevant. However, market rotations are not measured by time, even though I know we all start out using 5-minute, 2-minute, maybe tick charts, 15, 30, 60, all this, right? Not really, but you can call it whatever you want. Context is king. I mentioned at the top of the stream, this is a trend day. You don't take plug and play and think it'll work the same. And most of us, when we start out, are curve fitting. We think one approach fits everything. I'm going to suggest maybe not. Now, that's up to you. But if you plug and play, curve fit, and you keep waking up in the same place because what works one day doesn't work on the next, and in spite of the random winners, you're still losing, and you don't have a sustainable process, it might have to do with your lack of understanding of why certain conditions, certain trades are qualified, and in other conditions, they're not there. Can you differentiate? That's context, and it might be the more difficult things to decipher, but you can learn that in the Trader Lab. Now, where does order flow fit into all this? And Bookmap. This is what I call the tip of the spear. This is where you actually get down to where the financial rubber meets the road. Execution and staying in alignment with the shorter term liquidity, icebergs, absorption, the more minute structures that we actually use for triggering and trade management. All of these pieces need to be in alignment in order to extract your edge. Now, let's go take a look at the market. Let's try to look at the market. There you go. This is Friday. Now, Thursday. Now, you remember Thursday, we had the Acapulco cliff dive, and we had a down day. This was our target, 37 on Thursday. And that was our support. That was our target. We're sticking to it. Now, we also, on Thursday, 67.17, these are called singles. And I can't go into them too much, but to say that a single is support because it's an outside edge and the market ran, and it's like an internal gap. And on the other side, so we had the target on Thursday here, and then we created a new single at 17 up there. And then on Friday, what happened on Friday? Well, if this is support, and this might be, underlined, too low, then what? Let's go look at Friday. Remember this. 17, single, down, hurry, down here, going up, hurry, gap, internal gaps. And this is market profilage, as I call it. So we had a long down here, called the IBF. It's a structured trade. Now, in between, the market was rotational, different plan, okay? And we had sellers on Friday, and you can review this if you care, in Friday's stream, that we had our sellers up here, and we were doing this rotational thing. We broke down here, took out the first hour's low, and that's called the IB extension. Now, the thing about this is, and I was looking for longs, either under this low, because there's stops here for the, all right? So we came down, took out the first hour's low. I called that an inventory grab, but no way to know. So it was either long here or long there. And this was in Trader Lab. We got the long here. Who knew? So it goes like this. If coming down, if this, then that, take it out, and that. So two possibilities. Both were longs. If not, which means we get the extension here, I call that a stop pick. In other words, inventory grab, but you don't know. Or here, either way, long or stop, right? Part of the joy. And we get our long here. And then, since we hadn't taken out the high of the first hour's high and the potential based on our context grid sheet that I've shared in Trader Lab was for potential what's called neutral day. That means take out the first hour's high, or first hour's low. We got this first, and no clue. Remember, we're the clueless. If I take this out, then the shorts that are in this leg get squeezed, and if we come out here, where do we go? Maybe there. And this was all on, let's come back, the chart from before the open on this day. Now, the joy of trading is, remember I said rotations are random. So the auction takes place in all time frames. Now, let's come back. So what do we have for today? This is the 17, the target from Friday. Who knows? By the way, this is our RTH open, a gap, and we'll get into that. And our targets are this high. Why? Buy stops are here. And then potentially another single up at 83. Again, clueless, not important, random. Let's go look. And now this is our open. We got the stops up here, and we're going for, who knows? Is everybody with me so far? Is this making some sense? And welcome to Trader Lab. Again, I'm going to race along here because I want to get into our real time. Okay? And remember the purpose of this stream, guys. There's no plug and play. This is to help you see that there's process, not predictability. Part of the thrill of trading is operating in a random environment. Now, let's look here. I'm pulling out my grid sheet, the same one you'd have if you're in Trader Lab. What does it say? We're opening out of Friday's range and out of value. That means, and let me tell you what it means. So Friday's range, this is Friday's high, okay? Value area is here. That means where 70% of the volume took place. Don't worry about it. The overnight or ETH volume point of control is here. Market profilage. What is this volume point of control thing? I know when I first learned this in the mid-'80s, I was going, what are you talking about? All it is your shopping experience. It's high volume. Now, the thing about high volume is buyers and sellers are agreeing to do business. And when you have high volume, it's a price check. Think of your supermarket. If a price gets too high for your tuna casserole, you might pay it because you need it for dinner. But there's not going to be a line to buy the tuna. So if the price becomes too high, we can leave it. I'm not paying that. And everybody gets in the car and goes to a different retail price or a high volume area. But what happens if we have a high volume area and it's too low? What does that mean? Well, maybe, we don't know at first, maybe if we open and we're opening what? Out of range in a gap, what does it mean? The market is out of balance. Now, my last retail price in my last auction, ETH, or the overnight volume point of control, is here. Well, we have a high probability of testing this, and we can fill the gap or something, right? And so that's the anticipation. There's another thing. The ETH high is right here. We have a high probability of getting there, but the ETH inventory is also out of balance and long. And what often happens is it rebalances. In other words, that inventory has to equalize. So the first thing is gap, out of balance. Do we get a rebalance in the ETH? In other words, selling, profit taking, right? Oh, a gap, party time. Oh, let me get some dollars off the table. That's the anticipation. Now, the process. Now, let's look at process. And this kind of evolved for me when I built trading systems because I was a fund manager. I was managing a lot of dollars, and it was position trading. So you understand, put the thing on, take a nap. And so it was across a lot of asset classes. But part of the programming, the code I was writing was like the conditional statement. If this, then that. So if we gap higher, if this, then that. Equalization of the inventory, counter rotation, profit taking, it's called responsive selling. So if this, then that. But if not, then what? What? Well, is the market responsive? Responsive selling? No. What do? Trade in the direction of the imbalance. Are we continuing to drive up, gap and go? Yes. What does it mean? By the way, this is all in your hands. Possible trend day. What do? You trade in direction of the imbalance. What about the range? The potential is unlimited. What does it mean? What happened? The market has rejected the prior interpretation of value. The market is broken out of balance and value is yet to be determined. This is your supermarket. What's this? I can't get my tuna. Where's the price? I don't know. Maybe there's a shortage of tuna. Uh-oh. What's the price going to be raised to? I don't know. It's going up, 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 up. We better buy more tuna. Trend day. Does that make sense? This is the Trader Lab. Now, let me show you structured trades. Now, here's the thing. There is no plug and play. This requires you not to do what other retail traders do. And why would you want to do something different? And it doesn't mean you'll be successful or build sustainability. Obviously, there's no simple to this in the sense of plug and play indicators and time frames. Wouldn't it be nice? We'd all roll ATMs in the basement. But the failure rate, as you guys know, is over 90% for retail traders. Why do you think that is? It's because potentially you have no understanding of market mechanics and the fact that trade plan is required. We're not making it up here. Before the market opens, we know what we will do. And if we use a conditional statement, if this, then that, and you don't get the responders, then what? Get long, young trader. Get long. And how do you do that? Trade plan. And come to Trader Lab if you don't have an edge. So let's go. And again, I have limited time here, but you can learn this on Trader Lab if you're interested in the business of trading. And here's the thing, a fallacy for all of us, and this means me and you. We all have winning trades. So we think we're on the right track. We just have to persist and make it better, right? Guess what? Gamblers have winning hands. Sure. But what about the house? Even though they pay to gamblers in the casinos, don't they extract the dollars in a random distribution of outcomes over time because they are playing with an edge? So that's our business, guys. Not plug and play, not being right, not predicting, not picking the high of the day. How many of you right now are listening to this? We're saying it can't go higher, and you're shorting minor counter rotations and taking stops. How many are using plug and play indicators to say, oh, it's going to go down, and all it is a shallow counter rotation? If you understood the context, you would not be taking shorts. You might be using, quote, shorts for trade management, but you would not be getting short. Of course, up to you. And do you have an edge taking shorts? In a trend day, you need to know we are out of balance. So the only thing we have and I'm not saying you, I'm talking about me, is longs. Long continuation trades, and there's structures for that. Let's go take a look. RTH open. Now, what are we looking for here? Inventory rebalancing. What do we know here? This is the last auction, the last retail price. What happens if we open and we do the, I'm out of here. Right here, no clue. Right here, I see a sell sweep. Now, if I saw a buy sweep, and I'm looking for a long here because I'm out of balance, so I'm looking for a counter rotation to get long. All right. ETH highs here. So I know I have a high probability. I can't go over statistics. They're available in Trader Lab. You can get those. You have to vet everything for yourself, and I mean everything. And I get something called VPOC migration right here. Now, VPOC migration is a very specific process, and it is advanced process. Hold on one second. So we have what appears to be a impulsive move. Impulse means higher time frame, and the I'm out of here, I'll see you later trade. So look at the buying here. So right here, and right, oh, I gotta make sure. Okay. I call these variable high volume nodes, and I made it up years ago because this is the retail price. Let's go back to our shopping analogy. And if this is too low and the volume moves higher, remember buyers and sellers, and if you can't buy your tuna over here and they raise the price, and now we see the sellers and we see the buyers, the high volume is here. Remember shopping. This is like your convenience store down the street, the little mini mall, or not mini mall, mini, grocery store. And you need your tuna, but the price is too low. The market can move away from it. Now I run into this liquidity. This is possibly resistance. So I need to see the reaction. So what I have going on, it's too low. And right here, no clue, except I have this sweep which says potentially higher. I break high, resistance. So let's watch the market mechanics now. And I'm going to show you some initial trades. Now, this is advanced, what I'm going to be showing you. So I don't want you guys to get carried away with anything. This is an order flow trigger. And again, this is one of the more advanced concepts, but I'm just going to talk about it for a moment. Sellers are here. You see the icebergs going off? If I break, and here's resistance, sellers, so they are absorbing the buyers. Now I'm into order flow. If the resistance, you know the concept, if I get above it and I hold it from the other side, I then have the potential to go higher. I run into it again. Watch the same concept. And now again, these are advanced. This is not where you start. You have to have other pieces in place. Now, we come out here. This is an outside edge. One of the ways to trade these behaviors, a trend configuration, and this is why I always suggest in Trader Lab, the primary tool is something called mean reversion. And mean reversion is the fundamental, when I mean fundamental, I'm not saying simple. I'm saying fundamental basis of market mechanics. It's because it's rotational trading. Now, a lot of retail traders trade breakouts. I don't because of the risk. Do I want to buy this? Well, I know it's support, and do I want to buy this? I know it's support, but if I get a counter rotation, I can now identify an outside edge. And what's an outside edge in the shopping experience? If the retail price or high volume is there, I'm not paying that. Yeah, but it's on sale. I can then rotate. That sets up outside in trading or rotation. So let's go take a look. VPOC migration. What is this? Now in multiple time frames as you think of them. There's no time here though. That was too low. So, and what this yellow line represents is the highest volume in the developing daily time frame. So when you think in multiple time frames, down here, this consolidation right here where that liquidity was is high volume. We broke above, it's too low. I move away. I then have this one. I break away, I test it, too low. I rotate. Now my outside edge is out here. And this is the new retail price. We're now in the shopping, right? This is shopping. If I pull out here and it's on sale, I can rotate back. That is mean reversion. Underline the term mean. Watch. But what is happening here? VPOC migration. So what do I know? Let's talk about what you see right in front of you. This is the new retail price. Now, if it goes on sale, I could buy it. And then with a shopping cart, oh, throw 3 in the cart. Tuna is now here. They put it on sale. I buy it. I don't know. What do you think? And this yellow line is showing me the migration. I call this VPOC migration. It's a specific pool and it's advanced methodology, and it is only qualified in certain conditions. And this condition is called a trend, right? Trend day. Different. Your plan, this process, what I'm showing you here, would not be qualified, and you'd get potentially could suffer the consequences of not being in alignment. So certain trades are qualified in certain conditions. They are plan based. When you come into the market, assuming you've been in Trader Lab and you're doing the work, you know what you will do before it happens. The thing about it is, you know what you will do. You do not know what the market will do. Once the market shows its hand, you pull out the trade plan for the current market condition. And since we're doing a narrative of if this, then that, when it goes into if this, then that, if not, then what? The if not, then what is either stand aside or a different plan, or get in the Barca Lounger and wait and see what happens. It's just plan based. We have support here. Let's watch it. Let's look at the liquidity. What's going on here? High volume is migrating higher. This is our retail price. Here's a liquidity trigger. Who knows? Let's see what happens. It can do anything. Watch. This is support. This is advanced, so don't get carried away with this. This is our retail price. And if it pulls outside, it would be mean reversion to get long. Heavy on the mean because nobody knows where the outside is. So, too low, right there. Nobody knows. Absorption, you have to know what you're doing in this. Liquidity trigger here. Break above it. Potential support. Variable high volume node. This is your retail price. This is like the 7-Eleven or the Mini Mart down the street. I'm in fractals or multiple time frames. Break high. Buyer still in charge. Thanks for playing if you got short. This says counter rotation to sweep. It doesn't say get short. You need to know the context to qualify the trades. Up we go. Now what? Liquidity, obstacle. There's your sellers. This is like Pac-Man. Do the buyers consume the sellers? You guys ever play Pac-Man? Or do the sellers absorb the buyers? So the sellers are here. The sellers are here. The outside edge is here. The possibility is to go, oh, it's on sale. Retail price, microstructures. And when you can get down into such micro here, you'd blow your mind. Watch. Where's our support? Last retail price. What's this? Current retail price. Tom, they're putting it on sale at the previous price that is now too low. Throw 3 in the cart for me. Well, yeah, I got it. All right. Potential long. Where to? Mean reversion, if it gets there, that is the scale. Comes down to VWAP to VPOC. VWAP, so you could get long here. You could get long here. This is a variable high volume node. This is the new retail price. What does it say? More volume here, right? Here. Then we have a structured trade. So if you got long here, let me explain. If you got long here, this, and there's stops under here. If you got long here, you're trying to go there. If you get taken out, guess what? It happens. You take a stop. If your stop is below the VWAP, and there's also another structured trade in Trader Lab called VWAP to VPOC. But in an uptrend, it would be VWAP to VHVN, which is this. So you and that. which is a order flow trigger. So this order flow here can become resistance. When you break below it, it is resistance. And over here can be support, and trigger. And nobody knows. So if you get long here, you got to go there. You get long here and you got a tight stop, you get taken out. If you get long out here, you're going to scale there. And if you can't handle it, that's trading. Scale here. VPOC migration. Let's see if this, and by the way, time frame wise, it's up to you. This is a long, you got it here, you might get popped. Life in the fast lane. Because the idea of this was to go there. The idea of this is to go there. The idea of this one with the sweep is a long to go there. Same trades. Now, these are just examples, guys. You can take one and get back in the Barca Lounger. It really doesn't matter. What's happening over here? Potentially long to go there. Watch. Come back. Variable high volume node. There was a buy here. There was a buy here. There is support over here. Just taking you through the trades, guys. I'm not saying these are any good. I'm not even saying anything more than this is structured trading. Now, you determine what you're going to do with this, not me. Liquidity in the book. Buy sweep, buy sweep, buy sweep suggests counter rotation. We get a sell sweep. We have our support here. We have support out here. Let's see what it does. By the way, remember the target. 67, where was it? Lost my mind. Oh, here it is. 67.50 was where the stops were over here. So that was a target. So the idea was to come up into this. Then our next target's going to be up here. And then don't forget, we have our target sitting at 83. None of these are trade recommendations. So while you're operating in all of this, while you're operating in all of this, you have to keep in mind the structure and where the fuel is. VPOC migration, sweep, continuation long. Where you're trying to go? Here. Now, you don't have to go anywhere. You can just be hanging out. You never have to do anything. This, I posted in Trader Lab. I don't call trades. Remember, I'm clueless just like everybody else. Clueless doesn't mean ignorant. It means we don't know the outcome of anything. Now, support, why? Resistance into, now this one I posted, and this is resistance. This is support. Sweep. Now, this sets up an outside edge. This is reversion. Let's go back to the concept. Oh, it's on sale. Retail, too high. Watch. This is just a trade. It's nothing more. See? So, long in the Trader Lab. Order flow trigger, outside edge. It's called a low volume node. And what it is, oh, it's on sale, your shopping cart. Retail, high volume, right here. And then if I can get above this becomes potential support. Order flow, trigger, and the IB continuation trade. What is this thing, you say? This is a structured trade I shared. I've shared 60 PDFs of structured trades. Now, before everybody gets carried away and thinks it's plug and play, don't bother. It doesn't work. If it did, we all would have done it. We'd all be hanging out, and they'd be moving the second ATM in the basement for you. It doesn't work that way. Why do you think retail traders don't have sustainability in spite of winning trades? Because they don't understand the market. They never thought they had to learn the market. They thought it was learning the magic mix of indicators and time frames. Wouldn't it have been nice? I'm telling you, it would have been for me. It would have saved me a number of years doing the same stuff. This is potential support. This is a sweep. This suggests the potential for counter rotation. Let's keep going. Now, the trades I'm showing you are not micro, but short-term structures. They can be used a number of different ways. You could use them for trades. You could also be long from further back and trailing behind these distributions. That's a trade management question. You have to answer it. Certain processes that you determine, you may want to go, I want it, this thing's going, maybe, and we don't know where it's going, by the way. That's part of the thrill. This is my target. Do I want to micromanage this, or do I want to be out here? The answer lies in your trade plan and your extracted statistical edge. Other traders in Trader Lab are going to be using short-term rotations to, get out, put it back on, because they're trading this. Other traders are going to be sitting with their stop under the low of the day and go for a nap. We have traders in here to go to work. We have other traders to go to the gym. I know one trader who just takes a nap in his Barca lounger. No names are being mentioned, but in the Trader Lab, you know who these are. So, potential support. Now, support doesn't mean it's not going to take it out. It's just urgency and resistance. You know the concept, resistance might become support. You also know the concept that if this is the shopping experience, that maybe out here might be too low. We don't know. Let's find out. No way to know. This becomes potential resistance right here. Break low. Now what? Uh-oh. Where's it going, Tom? I don't know. Let's look. Where's our support? Let's come back to the other location here where we had resistance. That was a buy for us. What's under the first hour's high, which was our long? Stops. That I call that a stop pick. Support, stops, and trend up. Am I taking shorts? Not so much. You, go ahead. It's all right. Do you have an edge? It's your trade. That's your job. Not to predict. I get my sweep. I know my stops are under here, and I already know I may have a long here. I get the stops out. I call this a stop pick or an inventory grab. Now, when it comes down here, clueless, but not ignorant. So when I get the sweep, that alerts me, and I see the absorption. And let's look at delta for a moment. Haven't had time for that today, but you notice how the market's going down, and I got less selling, a little bit of buying, and now I got a lot of selling. I'll open this up, and I'm only running through this quickly. This is delta divergence. So I have my market going lower. I get my sweep right here, and I have my buyers. Now, I'm at a location, but I know there's stops. I don't step in front of the freight train because I want the stops to come out. So there's my stops. You could see them, 19, 20, and I got my selling here. So I got some good, and you can see it in the delta. Now, what's happening here? I see the sell delta, but what else do I see? I see absorption. Because I got the red bubble. Why do I have green delta? Because those sellers. Now, the thing, you remember what delta is. Sell stops, market orders. So what I'm seeing is the market orders, but I'm seeing absorption. And this is really what I'm seeing here is the buyers. See how we have, where's my sellers? I'm seeing a little green delta here. That is showing me the possibility that this is just being absorbed. And let's go back to the other piece. Location. This is like real estate. What's the other piece? Stop pick. Right here, I break high. This is an order flow trigger. It's a trigger, not an order flow trigger. But the order flow is there with the sweep, stops, absorption. See the change in the behavior. The buyers are now above the sellers. Trigger. This is a long, and I got a scale here. See the behavior? That's my scale, and it's coming from back here. No time to go into it. And now it's trade management. Put your helmet back on. VPOC migration. In the developing daily time frame, this is our new retail price. In here, this little microstructure. See that little node sticking out? I'm just going to show you a trigger very briefly. Just want you to see that if you think, you guys think in time frames. I understand. Not a big deal. What you need to be thinking is not by the clock, in my opinion. You need to be thinking about the behavior of the buyers and the sellers. It's not regulated by time. So for me, I'm not trying to fit the market into a rigid box. I am fitting the market into structure and reading the behavior. Now, the behavior here says the price is too high. I'm not paying that. Down here, the buyers, the sellers. Now, where's the volume in here? It's there. This is like your volume point of control, but in a microstructure. So if this becomes too low right there to test, so here, too high, too low, break high. That's a trigger. This is your support. You could buy it there with a stop under there, not a recommendation. You have to vet it. You can buy any of this right here because the trend is up, and off you go, and you're having a wonderful time. Let's watch. BPOC migration. Going to the moon, Alice. Really? What's this? Sweep. Where's my support? Down there. There's the liquidity. So far, rolling along, and it will reverse at some point. Next target is 76. You can get there. Watch. You'd get taken out here. You got support here. You got support here. Break support. Now we're underneath this. This is the current retail price. If I come outside, I can still look to revert back to this. Remember the shopping experience. What time is it? I'm trying to see if I'm getting caught up. Okay. Let's look here. Sweep. Now I'm going to show you another trigger. None of these are trade recommendations. Now, this is called mean reversion. Now, the stops are under here. Remember, we've had a couple of longs here. I come down. I take out my stops, which would be under here. I get the sweep. Out here is something called a low volume node. And what it is the outside edge. This is the shopping cart. Now, there's no precision in trading. What this sets up is mean reversion. This is the mean. And reversion trading is a fundamental approach to trend continuation trades. So far for me, and when I say me, I'm saying for Trader Lab developing traders, the idea is in a trend configuration, you're not taking shorts. You're taking long continuation trades until the context changes. Context is still up. But intraday, what's now is we've gone into balance. Balance is reversion trading. Now, the trick with balance, and there's no, is where's the outside edge? Well, we know there's stops under the first hour. We've had a number of longs there. And if I come outside, we're looking for reversion. If this is the fair price, let's go back to the supermarket. How far down or how low might this go before the shoppers, you and me, say, wow, they're knocking 75 cents off the can of tuna. Let's throw 4 in the cart. And now the demand exceeds the supply at this price. And then we come back to retail. That's essentially what mean reversion is. 1 second, I got to turn some levels on here so we can kind of see them. I export these from Investor RT. They're going to help us see the low volume outside edges and the high volume. And essentially what we're trading is the following. Now, nobody knows where this is. Let me do some micro reading of the auction. This is the retail price. Sellers are here, buyers are here. I'm just going to do a little something here. This is like a sidebar. And you guys know what a sidebar is. Go over and talk to the judge. Hey, judge, what do you think? So these are micro consolidations and they're auctions. I'm not paying that in this little store. Yeah, but it's on sale. I leave the high volume. I'm not paying that. Trigger. test, leave. Okay, microstructure. What do I have here? Sellers, buyers. There's the absorption. Let me just show you. I'm just showing you, not trades, how you can narrate the market. What's it doing? I don't know. Here. Fabulous. Let's try this again. I'm sorry for going so fast. I don't have a lot of time. You can get more of this in Trader Lab. And Trader Lab's not about me. It's about the process that I've kind of extracted over many years and a lot of wear and tear. Sellers are here, buyers are here. Trigger. Where's my high volume? It's right there. See the test? So I have sellers, test, sellers, see the trigger, test. Now, break high. What does it say about this? Maybe it's too low. Maybe not. Let's see. Test. There's my sweep. My volume is here. Break high, then back there. Right? I don't know. Does it go there? I don't know. Yeah, there it goes. See, this is reversion trading. So I just want to point it out to you. You could be getting long here against this. Here, let me show it. This is where the behavior changes. You see how the behavior comes here? If that's too high, I'm going down. You get the sweep, break high, trigger. The volume is here on this. This is all triggering structure. You have to isolate these and learn them. The sellers are there. It reverses there. And now the volume is here. So it becomes your support. See that? And then this is where you're trying to go. Mean reversion. I always say mean. Yeah, mean. Yeah, it is mean. Support is there. So if you got long, you're going there, and your stop's got to be below here. And again, you have to vet that. Sweep here says counter rotation. Let's watch it. I haven't seen any of this. I'm clueless. What do I? Oh, there you go. Okay. Everybody tracking. Now you have questions. I can take a look at them. Apologies. I'm trading from Mexico, so I can't see the chats. I will try now to bring them up. YouTube, if you're getting something out of this, thanks for your patience. Leave a like. Hit the thumb up, support the channel. There's no cost for Trader Lab. It's open to everyone. It is a serious professional community, just want you to know. So it's not like many of the quote chats and the other stuff that you guys have hung out in. This is business. And if you were sitting on a trade desk with me, like other traders I've taught over the years, it's no nonsense. We do have fun. There is humor, but it's serious business. The Trader Lab's about the business of trading. So I know we all want to have fun, but video games are video games, and let's just look at it like video poker. Okay, that's gaming, and you're a gambler. Fine, have fun. It's going to take you work and changing your behavior, understanding the psychological impediments to sustainability. And you're going to have to change what you believe the business is. Sorry to disappoint you. It's not a basket of indicators and time frames. Wouldn't it be nice? We've all looked for the Holy Grail. We've all looked for the secret sauce that everybody who's walked in our shoes previously must have missed. But we're going to find it. I know. And we have winning trades. I think the ultimate catch-22 to developing traders is the winning trades they have without edge. Because we always think we're on the right track. We just have to make it better. Is that you? Me. Anything you've done, I've done, except I took longer. I started in 1980. Technical indicators, as we know them, were new. I shared an office with George Lane. He created stochastics. You might be familiar with that. I thought that was the Holy Grail. Look at that, the line cross. And, and you go from there. So, Elliott wave. I don't even want to go into it. Fibonacci, pivots. I mean, so much. Gann, pitchforks. Somebody was talking about a pitchfork. I had forgotten about that. It doesn't matter. It's all the same. The thing is, if you stripped all of that away, what would you be left with? Would you have more or would you have less? Our rational thinking is we would have less. But what if it was the opposite? If we stripped everything away and we had to learn to read the language of the market, when we'd be further ahead than our competition who is just in plug and play world, the gamblers. Which one gives us an edge? Do we know what an edge is? Or are we making it up and playing a video game? I think it's okay because we need the gamblers. But the house or the casinos, they're not playing it that way. They're only playing games with statistical edge or probabilities. They're not attached to the outcome of any individual hand in the casinos. They play their games with something called anchored inputs. And I like to talk about this because most of us are using random inputs. You know, multiple indicators. It's a 70% RSI over here. Maybe it'll work better with 85. Well, today would have been 90. Let's use a Keltner channel and the 20 SMA. But you know what? That anchored VWAP, if we throw this over here in a couple standard deviations, look, oh, let me change this over here. Is that you? How about this? It's all of us. Except if it doesn't work, don't keep doing it. That's all I can tell you. And it does work randomly. I think that's the other thing. Here's the other piece. And think about, ask yourself if this is you. What are we looking for? Certainty, predictability, confirmation, right? Why are you looking for that? Because psychologically, we're wired to avoid risk. You know, the saber-toothed tiger. We need certainty. And chemically, when we look here on the hard right edge, we don't know what will happen right here. So what do? We wait until the market is here, and then it's FOMO. Well, is this trade going to fail from here or from there? Is there a difference? The only difference is you have more risk with certainty. I have less risk with the same uncertainty that you have. Which one makes more sense, you see? So if we can't have certainty, no matter what our psychological needs are, then we have to learn how to operate in 100% uncertainty 100% of the time. And that's what the casinos have done. And the way they do it is they don't depend on the outcome of the next hand. They depend on consistency or anchored inputs to derive their statistical edge over a random distribution of outcomes. When I put a trade on, and it's not easy, of course, I am detached from what will happen because I know the only control I have is over the process, my execution of an edge, not the outcome of this trade. And this is not a recommendation, but it's interesting, isn't it? Let's see if we can get there. So, would you be getting long there? Or would you be getting long here? Or would you have been getting long out here, you see? Here to there, stop could be under there. Here to there, stop could be under here. You're going to take a stop or you're going to get a scale. You take a stop, you're going to go behind the garage and step on a rake 4 times, or you're just going to go overhead and cost of production. That's a business, isn't it? Not a prediction. If I can't predict, I need to detach myself from the randomness and accept it. So I'm operating in randomness, not in predictability. So our goal as risk-adverse beings is to seek certainty. Well, here's what I'm going to suggest. You can't bend this business to fulfill your psychological needs of certainty and avoiding risk. You need to bend yourself with a business model that's proven, and that's gaming. And that means you are going to be uncomfortable. The way to get control of your discomfort, and this also takes practice, is doing the work to extract statistical probabilities. The casinos are comfortable with paying the gamblers because they know they're playing games with anchored inputs. So there's no variable on how they play the game. They always deal the cards the same way or spin the wheel or whatever they do. It's always the same. They expect to pay the gamblers because every business has overhead and cost of production. Somehow we don't want to pay. We just want, quote, the gains. There's no business on the planet that doesn't have overhead and cost of production. Can you change how you experience stops from a personal failure and the lack of your ego or your self-worth being verified when it's not about that? Isn't it about a plan with a statistical edge? Isn't that the measure of being able to execute a plan in randomness when you have fear? How do you transcend that fear? It's with statistics, tangible statistics, not emotional responses. Does that make sense? Can you see why, if you took along, that might be where you're going? And what is this trade called? It has a name in the Trader Lab. It's called mean reversion. And that's the mean, underlying mean. So reversion trading, and this is, in fact, there was a lengthy discussion over the weekend. It took a few hours, and it's posted in Trader Lab. You're all welcome to Trader Lab about mean reversion as the primary behavior to learn. Because if you can understand why, and that's it, why, how can I be here with you and talk about rotational continuation trades, which are reversion to the mean in all fractals or time frames? How can I do that? Because of the primary elements of market behavior, not predictability, but behavior. Why does the market do this? Why might this be a long? Why might you take a stop? How about both are correct? But what is the edge? The edge is longs in a trending environment. Does that make sense? Does that make sense that this might be the target? Again, not necessarily. Why might it be the target? This is Friday's target. This is today's potential target. Try not to blow this up. So this is Thursday's low, single. Let's come back. Test of Thursday's low, the long, a structured trade. The target there, high of the day. Not anything more than coincidental. Isn't it just a coincidence? But is there something else to coincidence? Isn't there a coincidence but what about statistical probabilities? What about auction mechanics? What about understanding how the market works? Do you understand that? Do you understand it? How the market works, a chassis to overlay these trades on, the rotational dynamic or time frame you trade. Like I said, some traders are in a Barca lounger. I know another one who goes to the gym or takes a nap. Other traders are trading the shorter rotations. The longs I'm showing you are time frame based. The context is what? North by northwest, trend day configuration. No shorts for me, maybe for you, or shorts are what? Trade management opportunities for getting long for continuation trades. Here's the tool when we zero in. I call it the tip of the spear. This is what's going on, guys. That's trading. That's trade plan. That's Trader Lab. You can learn this. And of course, you got to vet it. You got to roll your sleeves up. And the hardest part for you, most likely, is going to be changing what you believe this business is and undoing the habits you've created in order to avoid fear and to create certainty. If you can accept it doesn't exist here, then don't solve for certainty. You can't have it. You make those decisions unconsciously because you're wired to avoid risk. When I started in this business, my concentration is on finding certainty, avoiding risk. And that's where, and because of the winning trades, I said, well, if I can squeeze the risk out, I'm going to have more winning trades and I'm going to lose less. Isn't that what we all think? Where is that decision coming from? It's our primal wiring to survive. When you're right here at the hard right edge, you are uncertain, aren't you? So what is your nature? Wait. Well, what is this? Right down. By the way, that's a bracketing algo. Does it matter? No. You know what matters? Your trade plan, your statistical edge. That's what matters. If you don't have an edge, you don't have a trade. This is mean reversion. This is the last long. That's the scale. And where we try, and it's not a recommendation, it's just a trade. Current high of the day, this is a target, and we have more. 80, where'd that 80 come from? And we have 83. So we have resting liquidity at 80. That's enough, don't you? So it doesn't have to get here. Remember, you can be, and the other part of this is trade management, time frame based management. Nobody knows, it's like, I don't know. Do you? I don't. So if I can't know, my job is not to predict. I'm not here to say it can't go any higher or let me sell this. It's going to go down. Here's the thing. It might go down and it might keep going up. Do you know which one? I don't. So my energy is not there. My energy is not in predicting. My energy is in alignment. That's what the trade plan is about, not predicting. Hope that makes some sense. Please give a like if you're visiting in YouTube. This is Trader Lab. It's open to all of you. There's a link down there if you're inclined. Let me see if I can find a little bit of Trader Labage for you here. Maybe. And by the way, the Trader Lab is a community of like-minded traders come together to leverage their collective experience. This is not about me. Yoga? Okay. Meditation works really well too. By the way, there's a lot in here. You can see Trader Lab, a lot of interaction, charts posted, agreements, discussions, disagreements. It's a community, but it's all business, okay? So it's not romper room. Guys, the weekend discussion, very important, about mean reversion and trader development. It's available in here. Trader Lab is a no-cost community. I also need to show you the primary webinar. And Ned, thanks for curating this for us. The primary webinar talks about anchored inputs. Anchored inputs are basically how do you play games. So let's look at trades or setups, as you call them. I call them structured trades because they have the structures, the requirement for the qualification of the trade. So it's different because certain trades are not qualified in certain conditions. In the current condition, the trades that are qualified are longs. There are no shorts. Shorts, subject again to time frame and plan and your development, are exits for trade management, not fades. Again, not up to me. That's up to you. But this primer webinar has about 34,000 views. You might want to check it out. It's from 2021. Meet the Trader Lab. This is an advanced trader methodology. Now let's differentiate the term advanced from complex. This is the simplest thing I've ever come across, auction market theory. If you're a shopper, you already know it. What you don't know is how to understand shopping or auction mechanics and how to extrapolate that behavior and overlay it into a trading process. That's what you don't know. What you don't know is time frames as you think about it are stores or shopping. Rotation is a shopping experience. What's too low, what's too high, what's fair. And what the market does, and these are consolidations in all time frames, is check prices and either move away to the upside, move down, or hang out. Day trading, fantasy versus reality. Stop gambling, start winning. Trading multiple time frames. This is a vertical integration of time. So we can be getting short in one quote time frame while we're aiming ultimately for a higher target, a different one. You trade inside it. Think Matryoshka dolls, that Russian dolls are inside each other. So we could be short and long. Short in a short time frame, trading counter rotations and stay in a two-sided trade, break out of a two-sided trade, and then go one-sided in a directional move, and then go back to two-sided. I can change. You can learn that. You can trade from one side, you can trade from both sides, and in a configuration like today, it's primarily long only. And if the market changes its configuration, you get back in the hammock, or you have a plan for changing configuration, which you may or may not do. Trading multiple time frames. Day trading. Why most traders using indicators fail. Aren't you curious about that? High volatility reports, and there's much more. How your pre-market plan creates a trading edge. Trading VPOC migration. That's what I was showing you early this morning. Now, VPOC migration is the most difficult aspect of this because if you don't understand auction mechanics, in other words, mean reversion trading, which is what I've been showing you here, which is the reversion side of this, you won't understand the migration side. So I always say VPOC migration in the opening trades are the highest risk because of the volatility and the speed. If you're in a trend configuration and you're a developing trader, the mean reversion continuation trades, which is what I was showing you, these outside in trades, are the trades that are qualified for developing traders. VPOC migration trades require unconscious competence, which most of us just stay unconscious for a while until we develop competence. Here's a little something. Ex-prop firm owner tells you how to pass an evaluation. And then there's a whole document section. All this is available to you. And I have streams that are up to 4.5 hours long of real-time narration. So if you're interested in any of that, it's available to you. Again, there's no cost for that. And Ned, thanks again for keeping an eye on all this for us. Anyway, guys, hope you're getting something out of this. Hope you're finding the Trader Lab an interesting thought. And if you're in YouTube and you're visiting, Trader Lab's available to you at no cost. There's a link down there at the bottom of YouTube. You will not be solicited, harassed. You do need to verify your Discord username. You'll get a little code, and then you can verify it, and then you'll get into the Bookmap server. And by the way, the Bookmap server isn't just about Trader Lab. It's about a full suite of education available to you at no cost. Order flow with a high tier tool like Bookmap, other streamers, stocks, options, crypto, of course, order flow, market maker behavior, algorithmic behavior, and tons more. And it's all available at no cost. The only thing you have to do is you got to verify. So here we are. We have a sweep. We're at the IB. Remember, the IB is a structured trade, and we take stops. Don't want to take a stop? Then you can't trade. Sorry. Who wants to take a stop? I got to tell you, if you own a business, me, I own a business. It's this business. I started in 1980. I've never liked taking stops. Who's going to like it? But let me ask you this. How do you have a business that doesn't have overhead? How can the casinos afford to pay the gamblers, give you the cocktails and the ticket to the buffet, and if you're a roller, fly you in, send a limo to pick you up, comp your hotel room, and still make a profit? How can they do that? Because they have an edge. So how can we afford to take stops and everything else that happens in this business, which means randomly, because it's all random? And how can we stay in a business in randomness? How can we control our emotions, our fears? I call that Hyde. Jekyll and Hyde, the lunatic. Hyde is that emotion. And emotion is triggered by chemicals that are released in your brain. It's an emotional state of fear, avoiding risk. Well, we can't avoid risk if we're in a business of exchanging risk for reward, right? So how do you do that? Well, you have to understand yourself, and I mean yourself, and the mechanisms that are at work that will take you out of the business. And we all have the same thing. So we're not unique, but individually, we are looking for validation of our intelligence, our self-worth, and you're not going to get it here. What you're going to need instead is a vetted plan that has an edge. What is the measure of a successful trader? Executing a vetted edge, bringing your plan to the market, not playing a video game, not chasing the market, not moving your stop to break even when it's not part of your plan. It's discipline. The measure is not the profitability. The profitability is the outcome of executing a vetted edge, same as the casinos. If that makes sense, then come to Trader Lab. If you think you can predict, and no matter how much spaghetti you throw at the wall, that you curved it, like we all have, and you're going to have still random winning trades, but you're still going to leak equity out and eventually go out of business like 90% of the, and maybe you'll be the exception. I know we all think we're special. Maybe you will be. I'm not saying you won't, given the failure rate of everyone who's walked in your shoes, including me, and everybody else in Trader Lab who are at different levels of development. By the way, doesn't matter how long you've been trading. In fact, the less time you've been trading, the less bad habits you have to unlearn. And what your methodology is, it doesn't matter. What does matter is you actually have a desire to create a sustainable business. And it doesn't mean you will, because you're going to have to do things that you're going to be very uncomfortable with, like changing your beliefs and adjusting how you operate in this environment from what you want it to be. I know what I want. I want to know what's going to happen. I want to avoid risk. I want certainty. I also know that I have an edge right here to go there. Do you know that? Do you know that if you took this X right here as a trigger, right at this location, this is a sweep. This is the order flow trigger. Right here is the microstructure. Right there, sellers, buyers, sweep, trigger, test is where? There. This is called the IB continuation trade. It's mean reversion. That's the mean. If you get in here, you scale here. Now you get your helmet out of the closet. You go in there, hopefully, or not, and you have trade management process, which you already know what you're going to do. Does it make sense not to make it up, but to stand up, wait for the trade? It's like a bus. Oh, there's my bus. My bus is not here. My bus is not there. My bus is out here. My bus is out here. Where is my micro structure? My buyers were there. There's support. And look at what happens here. Let me show you. Now, I'm showing you a little order flow activity just to give you something to think about. Remember, thinking, very important in trading. You got to think. So what's this? Buyers, sellers, break high. Where's the volume? Let me see if I can do this without making too much trouble. Probably am making trouble, but I want to show you something. It says sweep, potential downside rotation. No clue. There it is. Where is this? There. I think this is the right one. Let's try to see. See how this trigger works? The volume is here. Break high is the trigger. Then you're looking for a potential return to check it. Right there. See it? So, and this is where, and for me, I don't put my stop here. And it's just a personal thing from my own experience. And that is I look for stop picks. Here's what it means. Retail trader behavior. Write this down if you're just visiting the lab. Think like a retail trader. Don't act like one. Everybody is risk adverse. Fine. What do? Oh, I'm going to put my stop here. I don't want to lose. I don't want to lose more than I have to. What is here? Stops. What might happen if I counter rotate and pick these guys off? You know how you always say, they picked me off. I have to ask you this question. Have you ever considered that you're getting yourself picked off by putting your stop with everyone else who's risk adverse? And by the way, we all are, except the difference is you need to understand retail trader behavior and not do it. Think like a retail trader. Don't act like one. Suppose my stop is here, which it wouldn't be. And it comes down here, and I see the absorption, and the buyers that are here, see these icebergs? And the liquidity shows up. And why are they buying here? Let's go back to shopping. Because they think this is a good price. It's on sale for them. Well, if it comes back on sale into the stops, might these buyers show up again? Do I want my stop there? No. You? Up to you. Me? Not so much. Support. So, support, break high. So I have the same thing here. I have break high, support, break high, support, 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 target. And the target's for a scale, not for anything else. Oh, where's my support? What is that? Isn't this a stop pick that I was just talking about? Buyers, buyers, sweep, buyers, to where? To there. That's all I can tell you. Is this making some sense? Please give a like if you're visiting in YouTube. There's no cost for the stream, so the only thing I ask is that you give a like. You have questions, post them. I'll try. But if you have questions and I can't get to them and you're in YouTube, come to Trader Lab. It's the best way. And it's not just, by the way, Trader Lab's not about me, it's about you. NQ, by the way, this process I'm showing you, this is how markets work. You can apply this process to any market, but you do have to vet it. As an example, NQ. We call NQ the snake. And the only thing about NQ is the depth of the order book. So when you have a thin book, like NQ might have 25 or 12 or something. So if you're using stops, which you have to use all the time, in my opinion, you might not get filled if you're using a limit, or your stop becomes a market order. They'll send you a postcard where they get your fill. It used to be when I traded NQ, and I was a high volume trader many years ago. You pick up the phone, call your guy in the pit, and they get back to you later. Yeah, much later. So that's how I used to trade. And I traded the large S&Ps, not the minis. So, and that was the only short-term trading for me, and that was swing trading. So I really grew up starting in 1980, and I don't think the S&Ps even started to 82. I really can't remember anymore. But for me, it was the commodity market. So it was very different. So, and I think 82 is when the S&P came. I don't remember, but we called them pinstripe pork bellies. Maybe like that. So, long scale. Then it's either going to come back under here. Because now, if you took this long, or the longs previously, these are structured trades, this is your primary objective. This is called mean reversion. The primary trade, I suggest every trader reverse engineer and really be able to do in their sleep, is reversion trading. The market is always reverting in all time frames, as you think of it. It's always coming back here in some version. This doesn't have to be here. This could just be a microstructure. So, as an example, let me see if I can find an example of this. So let's think of the market, what it actually is, an auction. So what it is what's too high, what's too low. Well, right here, let's look at this. You're going to, what? Yeah, I know. We're all crazy, and we're all thinking it's indicators. Let me show you my, quote, indicator. It's this. Oh, it's on sale. I'm not paying that. You see the volume? That's the retail price. What is this retail price? This is the shopping experience. I'm not paying that. Yeah, but it's on sale. I'm in a store. And if I drive away from the store, I can't buy it here now. Now, maybe it'll come back here later because I find too high. But if this store, too high, too low, retail is too low, I get in the car and I can't buy S&Ps here anymore. I drive away. Kind of a simplistic thought. But everybody makes trading so complicated. And I used to think it was really complicated. What I didn't understand was I was the one who was making it complicated. I never thought of it like shopping. I thought it was indicators, oscillators, envelopes, VWAPs. Well, yeah, maybe. It's not for me, though. Because the more I tried to create certainty and draw lines and all this stuff, this is not, the market doesn't care about a line on a chart. I mean, how many times have you guys drawn trend lines? You go, oh, it's a little off. Let me move it. What does that tell you? And yes, they work sometimes. This is where we get trapped. Where are some good ways to develop your edge? Come to Trader Lab. Yeah, mini mart versus the big box store. By the way, the big box store is the intermediate time frame. The supermarket is the developing daily time frame. And the mini mart is this: shopping, shopping, shopping. What's this? Too low. It was on sale. Sweep. What's this in the microstructure? The retail price. If it's too low, I leave it and I come back and check it. Sorry, Tom, no more tuna. Retail price in the supermarket. You want tuna? This is the price. The mini mart, too low. All I'm doing is going down in quote time frame, but I'm not using the clock. I want to say I don't use the clock because this isn't regulated. Nobody's here with a stopwatch going, you can't do anything for 5 minutes. Really? How about I can see it right here? When I see this in alignment, in alignment, in alignment, can I take a trade here? Yes. Oh, it's not 5 minutes yet. It's 2 minutes. See? Just saying. Now the trade has to qualify. Oh, thanks, JJ. JJ Marks is confirming that the CME introduced the big S&P 500 in 1982. Look at that, pretty good memory. And then they added the E-minis in 97. I wonder I was abusing myself with those big S&Ps. Think of what that was like. I was swing trading those things though, and by swings 2 to 3 day. So that was like my day trading back then. And I will tell you, going overnight with those things, that'll tighten a few body parts. But I also used to, I was a position trader, trend following. So I traded a lot of currencies. And back then, before we had currency pairs, I would spread them out right. So a lot of stuff, a lot of trend stuff. I traded across all asset classes back then. So I was managing dollars. So, but back then, there was no day trading. We didn't have domes. We didn't have volume. And that's why when I learned the market profile from Peter Stottlemyre in mid 80s, it was 30-minute brackets. They called them TPOs, time price opportunity. And I at the time was still using indicators and oscillators and all that jazz. And I decided I'd put them together and create something better. All I did was create something worse with random winners. So you spend a few years trying to, quote, make it better. And at some point, the light bulb goes off. Maybe I'm doing this wrong. Why am I keep waking up with Trader Groundhog Day, waking up in the same place? The reason was I didn't understand the business I was in. I was trying to bend the business to my needs to avoid risk and create certainty. So I thought more stuff gives you more certainty. It's human nature to believe it and to seek it without understanding the drive under the hood that makes you make decisions that are not in alignment with the business you want to be in. It took me a long time. And when I started, all my friends were floor traders. There were no off-floor traders. George Lane, who I shared an office with, the guy who created stochastics, he had an Apple I. This is back before there was an internet. This is before we even had computers. When I started, there were no PCs. I actually traded with a terminal or used a terminal. I can't remember. It was ADP Comp Trend. And basically, to get data, we had to run an extension cord from the exchange down here in Chicago, or there, I'm in Mexico at the moment, up to someplace in Massachusetts for data. So just to give you an idea, that's where I started. So it was very much draw your charts by hand and all this kind of stuff. Now I'm not saying that's a badge of honor. I'm just giving you a sense that I spent years as this technology and technical indicators were developing. I spent many years reverse engineering and then eventually being able to build trading systems in the late 1980s. So maybe the first 6-7 years of my trading was really manual and math-based. And then I got an Apple IIe, so I was high-tech. Just a little bit about me. Then I became a fund manager, an advisor, ran trading desks. It all took a long time to do it. So, but the thing is, for me, I was a very slow learner, but nobody told me this was gaming. It wasn't part of the conversation back then. Anyway, it's not really important. What's important is, unfortunately, I spent too many years with Trader Groundhog Day. working hard, waking up in the same place. Is that you? Working hard, tweaking, tuning. It was kind of like, getting a screwdriver out. Let me make this fit a little bit better. Oh, look at that. I would have caught that 20-point move. I'll be ready for it next time. Meanwhile, tomorrow's not today. In fact, the next hour is not right now or the next 5 minutes. They're all unique and they're all random. I never understood I was in an environment that's 100% random 100% of the time. Do I use the dome for my entries? Randy, I enter directly off Bookmap. But there's a dome in Bookmap. I can actually, with a Global Plus, I can execute right here. So what I can do is put my pointer over this thing and put a limit order in here, or whatever I want to do. And I use bracket orders primarily, so they're limits and stops. It just throws everything in together, and then I adjust what I need. That's just the way I do it. But you can do it. You can do bracketing orders, strategic orders, where they're spread out, all kinds of ways you can do it. So yeah, there's a dome. There's all kinds of stuff in Bookmap. In fact, I recommend you guys, if you're interested, go to bookmap.com. Check out. There's so much information and videos, short videos. You can kind of see what this tool can do. It's an amazing tool. I'm an early adopter of Bookmap. I think I got it in 2015, maybe somewhere in there, because I could not read the dome. It was too fast, too much flashing numbers. And, once the algos and everything came in, it really changed everything. So that was not my skill. I wanted to know what was going on over here, but I'd get delirious and fall out of my chair. So when this came in and I saw the heat map, so this is real time based on what's in the dome in the limit order book, and this is historical. So if this moves, I'll know this was here, you see. So when you see this stuff, and this is algorithmic here, or this, you see how it pulled, I can see what was there, and then the changes. So I can use this. And the other part about this is I understand what it means. In all of this, there's education, in the Bookmap server on what about this order flow? What does it mean? How do you integrate it? And that's why when I talk about the hierarchy of this process, if I can find this for you, this is really what it is. How does the market work? What's too high? What's too low? What's retail or fair? That's the auction. And let's translate. Shopping. You know how to shop? You already know how to trade. What you don't know is how to integrate it into multiple time frames, rotations. Are they micro or are they intermediate time frame? And it's all integrated like Matryoshka dolls, the vertical Russian dolls. Time is a vertical integration. So you got to look up, you got to look down, and the down is the microstructure. I call it the tip of the spear. The volume profile is a chassis. It just allows us to see the distribution of behavior or volume, which is the shopping. So the time frame is your thing, what is it? Context, trend day up. Are we going to fade it? Until it changes, they say it's not broke. And then order flow. This is this process. This is what I've shared in TraderLab, as well as structured trades. 60 PDFs of structured trades, but you have to understand it is not plug and play. You must reverse engineer this, know where your trade is, and sit back and wait. It's shopping and it's waiting for your bus. It's not more complicated than that. You can make it complicated, and that's our tendency. But what would happen if trading was not complex, but instead random? So you have to wait for the bus. It gives you a statistical edge. Like the casinos, don't make the games up. They only play games that have an edge that favors them. Would it make sense if you want to be in the business of trading, which is gaming, that you only take trades that have an edge that favors you? Does that make sense? If it makes sense, please give a like. Use the link in the bottom of YouTube. Visit the Trader Lab. There's no cost for it. But remember, it's about the business of trading. This is not romper room. This is serious business. If you're interested in the business and potentially creating a career path for yourself, that's why I created Trader Lab. Hope you got something from today. This is what a trend configuration looks like, and this is something you can learn in the Trader Lab. Take care, guys. Thanks for visiting Lab. Don't forget the thumb up on the way out.